It's great to have you with us. Let's get back to our top story at this hour. The U.S. Entering into the fray in Iran over the weekend, bombing 3 nuclear sites in that country. Now, U.S. involvement had stoked fears of a regional war. We know Iran has vowed to retaliate. But when you look at the markets right now, we have seen a rather muted response. So let's get some more perspective on how investors are navigating all of this. David Aspell is joining us. He's Co-CIO at Mount Lucas Management. David, thanks very much for being with us. You could make the argument that, at least for the theme in the stock market, that investors are largely unfazed at this hour. How would you characterize what you've been seeing so far?
Yeah, it does look, it's a little surprising. It does look like they're unfazed currently. I think that the worries run straight through the oil market, which currently also, as you said, seems like it's fairly calm. I think oil prices are trying to judge the likelihoods and the potential impacts. Iran itself is not a particularly large producer of oil for export, given the sanctions, and most of it goes to China, which is possibly part of it. The route that, where you get market turbulence runs through if you get some closing of the Straits of Hormuz that gets oil out. And I think that is likely to be the channel. And currently, there's some threatening of it, but it doesn't seem like that's happening so far. But yeah, it's quite surprising that they're quite as calm as they are.
And what will you be monitoring to try to determine what the mood of the markets ultimately looks like? You know, whether it's any of the developments on the oil front or any of the developments with respect to, you know, what Iran's next move is or is perceived to be, and how the U.S. responds to that. How do you navigate this as an investor trying to watch this flurry of geopolitical headlines?
What I'm watching is, do they stop the flow of oil out? I think that's the key thing I'm looking. You can see that, you can see tankers starting to turn around. If you see Iran start to attack ships, or you send drones, or just try and make it very difficult for oil to get out, I think that's the worry. And that sort of links into the broader macro markets, and as it runs through central bank reaction function, that stocks currently, I think, are at the levels they're at because they're predicated on the idea that commodities are not going to go up a lot, and that the central banks around the world are able to continue easing. And if you get some spikes in commodities, I think the Fed should look through that. But I think if it looks like the Fed would not, or those things do start to come to pass, that's the lens through which I think you start to see more worries.
And how closely will you monitor the country-by-country response? I think some people would say that allies of Iran could have reacted in a much more significant way than they have so far, and that might be one of the reasons why people think that things are at least contained for now. You know, I noticed that China strongly condemned the U.S. strike on Iranian nuclear facilities, but I was saying earlier that the U.S. Secretary of State has specifically called out China, saying that they would like for China to lean on Iran not to do anything disruptive in the Strait of Hormuz. So, you know, I think that in light of the fact that you already have trade tensions between the U.S. and many nations around the world, including China, how closely would you be monitoring that?
Very closely. I think that's one of the single biggest drivers. You've got the oil that comes out of the Iranian oil goes out through the Straits of Hormuz, and most of that goes to China. I think what the US is saying is that China wants to have a larger role in the governance structure and being a good actor on the world stage. If that's what you want, then this is one of the times where you need to act that way. And I think that is exactly the lens. It also means that, given there are trade tensions, it means that the US can also entice China to do some things for it, possibly through further relaxing of some of the trade tensions, that there's some more give and take that could be going on behind the scenes. But I think that lens of what is Iran going to do and who does that hurt, and if it hurts China, that's not going to be great. So if they're their ally, can they lean on them? Yes, I think they can. And can the US entice them to do that? I would hope so. Yeah, whether it happens or not, I don't know. But that's what I'm going to be watching. That's the route by which I think we get market issues.
Okay, and then just to further connect some of the dots here, again, We don't know what's going to happen with the price of oil. We don't know about disruptions. But there is a generally held view that if there are substantial disruptions to flow, that's the kind of thing that could lead to a spike in prices, which have already come up, we should mention, quite noticeably over the course of June. And then that potentially opens the door to some inflationary questions at a time when the U.S. Federal Reserve has already been trying to sort of push off any immediacy around, let's say, interest rate cuts. How do you think the Fed, I believe Jay Powell has some semi-annual testimony that he's going to be giving in front of Congress this week. How does he navigate all of this?
Yeah, it's a great question. It's a great question, especially when he's under some pressure from the administration as well. Typically, central banks find it easier to look through one-off price shocks that you come from tariffs and increases in the price of oil. But that's easier to do when you haven't just come out of a period when inflation expectations and realize inflation have been pretty high. It does reduce somewhat their room to maneuver. I think they do and they should look through it. Generally, I think if you get that, they should focus on the idea that those supply shocks like that are negative for growth.